Venture capital red flags. Look, if you're looking to raise private money from angel investors or venture capitalists, then you need to know the things that turn them away where they don't want to have anything to do with your business. You have to avoid these at all costs, because if you avoid these red flags, then it becomes easy to attract angel investors and venture capitalists, which opens up a whole different way to get money for your business, right? We don't want to just rely on debt, loans, credit lines, and credit cards. We want to be able to pull in private investors that can be strategic partners that can actually help us grow and also give us the capital we need that doesn't have to be paid back. But if you're going to raise money from VCs and angels, you have to know about these red flags. We got a lot to cover, so let's dive in. One of the main red flags is issues with your team. So look, venture capitalists are investing in your team and in you just as much as they are in your company. If you ever watched the show Shark Tank, you'll see many different examples of when they're investing in an entrepreneur over the product or idea because the entrepreneur is a potential standout success. Well, that's exactly how venture capitalists are looking at your business. They don't want to babysit. They want to know they're bringing in a person and a team that they can count on and meet with once in a while that is going to drive the ball down the field per se, that is going to increase the revenue, increase the profit of the business with as little effort and input from them as possible. So they're going to look for issues with your team. They're going to make sure you have the experience to be in the industry doing what you need to do. They're going to make sure you have the people on your team that are going to be the right support network to help you. The more high level or notable names that are actually there on your board of directors or board of advisors will also help you. They don't want any fighting or arguing amongst the team. They want to know that you have a clear, cohesive strategy for growth, and also that your team understands that and is on board with that strategy. They want to make sure that you are fully committed, that you're not doing this part-time. They want to make sure that your team members are actually communicating well and that your team isn't missing any of the critical skills that are needed to be able to move that business forward. Any of these things within this team issues category are huge red flags and will absolutely get VCs and angels to pass on investing in your business. And that brings me to issue number 2. Market issues. Market issues means any number of different things. First of all, the size of the market matters. They want to make sure that you have the ability to serve a very big market. Let me give you an example. When Yeti initially tried to go out and get investors, they failed because the venture capitalists they were talking to saw Yeti based on this narrow area they were for sportsmen. The category wasn't big enough. They weren't interested. When Yeti modified their products to work for everybody, not just sportsmen, all of a sudden the venture capital money came in and Yeti became a household name. This is one of many different examples of what happens when you actually have a large enough market. So venture capitalists, angels, not interested in a small market. They want to know you have a very big market. They also want to know that you have a grasp on who your competitors are. You never want to say that what you do is so unique that you don't have competitors. Look, at Credit Suite, we're the only company that helps a business owner improve their fundability, build their business credit, and get financing. But when we're talking to venture capitalists, we still tell them that we have competitors in each of those individual areas, even though nobody does all three together. This is what VCs want to hear. They want to hear that, yes, you have competitors. They want to hear that, yes, you know who they are. And they also want to know why you are better than them, how you're solving the problem and understanding the problem better than they are. What makes your solution unique, otherwise known as a unique selling proposition, to make your company stand out above that competition. Next, is there a demand for your product or service? They want to know that you've already determined that, not that you're out there thinking that their people may want what you have, but that you've actually tested it, that you've proven it, that you've actually shown that there is a demand for the solution that you actually have as the product or service in your company. And timing comes into it as well, right? Depending on the economic stage that you're in, you don't want to have the wrong product for the wrong economic time frame, right? And economic conditions matter as well. So what I mean by this is that when we're in a recession or we're dealing with hyperinflation, you probably don't want to go to market with some very expensive product that is designed for people that usually are tight on budget, right? You don't want to come up with something that's not a fit for where we actually are in the economy. So the timing is right, and it's not just economic climate, it's what else is happening. Are you coming up with some solution to create software that actually produces content? Well, AI's already taken over that. There's no future necessarily in that kind of endeavor. So this is what venture capitalists are looking for, is your timing spot on? This is the other thing that they're looking for in this category. Third thing that is a red flag for VCs and angels is your actual model itself. How does your business make money? Can you make revenue? Can you make profit? How are you going to do it? Look, if you're meeting with VCs and angels, they're going to ask things like, hey, what do you sell? How do you sell it? What percentage of what you sell is subscription? What percentage is product? What are your payment options? What is your one-pay pricing? They're going to want to make sure that your business model itself works. So if you have an unclear path to profitability, it's going to be a problem. You need to know what you're going to sell, how much you're going to sell it for, and what kind of margins that you're actually going to make. And those probably should be pretty high margins, or you have the ability to do a lot of volume with smaller margins to be able to build a profitable company. Do you have high acquisition costs? Meaning, is it a lot of money to be able to acquire a customer where you're not earning a big return? Or are there competitors in the space and nobody is succeeding, right? These are all concerns about the business model itself. Even unsustainable unit economics matter here. So what I'm saying is that, look, if you're trying to sell something way overpriced or underpriced, your margins aren't in line, this really is a big concern for VCs and angels. And here's what's interesting. Just by fixing all these things we're talking about in this training is going to make your business more successful and more profitable, even if you're not trying to raise money from VCs and angels. So make sure you have this right. Make sure you don't have any of these business model concerns. Next red flag is poor execution. So are you managing cash flow correctly? Do you have a business that you've even had around for years, but it's not profitable? Like, are you managing your cash flow properly? How much money is in your bank? Does your bank show that you're overdrawing the account? Are you increasing your revenue every single year? Using misleading or vanity metrics that they can see through. These are also red flags that VCs really do not like. Unrealistic financial projections. Having a lot of your money come from very few customers. These are all execution red flags where you might have a business that's generating revenue, but they don't see it as a scalable business that they want to invest in. And this brings me to the final category to avoid, which are absolute deal breakers. These things are going to kill you with VCs and angel investors. Let's talk about what they are. First is a messy cap table. Who else is invested in your business, and how clear is it that they can understand? Look, they should be able to look at your cap table and know exactly who's invested in your business, how much they've invested, how many shares they have. All of those specifics should be easy for them to be able to access. If you're adding somebody else, another investor to your cap table, they're not going to be happy if you really don't have clarity on the other investors who have already invested. Next is unreasonable value expectations. Look, if you've seen the show Shark Tank, you know how this goes. People walk in there all the time and they absolutely lose deals because the money they're asking for based on the valuation they have set on their business is way higher than what those sharks think it should be. Don't blow VCs and angels out of the water because you're valuating your business way higher than what it actually should be. Look, nowadays you can use AI and any number of different technologies and software to be able to get a pretty good idea of the value of what you actually have. So make sure that you're coming in with a reasonable value. And if you're talking to VCs and angels and you're hearing that the valuation is way off, then you want to go back to the drawing board and reconsider what they're actually saying to be able to come up with a valuation that makes sense. Look, this is an important note. I already told you the story of Yeti. What accounted for Yeti's turnaround is they actually listened to investors. Same thing happened with this little company you might have heard of called Topgolf. Well, Topgolf was basically just a chip in a ball. That's all they were. They were a driving range with a chip in a ball. It's the VCs and angels that came in and gave the advice of incorporating food and multiple different levels and an entertainment venue, and that's what makes Topgolf successful today. So the lesson here is that you need to learn from these VCs and angels. When you are meeting with them and they are giving you suggestions and advice, and you're noticing themes of these suggestions and advice, make sure you're using that to modify your presentation, modify your pitch, modify your ask to actually fit what they're telling you needs to be changed. It's going to make it easier for you to then meet with other VCs and angels and raise money from them. Next, deal killer is complicated terms from previous raise rounds. Look, if you have really complicated terms now from the current investors you're trying to woo or from previous investors, this is a huge red flag deal killer for VCs and angels, so make sure you don't do it. Make sure your terms are clear. They make make sense. They're attractive to VCs and angels. If you do this, then this won't be a deal killer when you're trying to raise capital. And finally, too much delusion. You've actually come in and you've diluted what you have so much that they can't have any control in what's going on. If you brought in so many investors and given away so much equity that they can't even have a say in what's going on and all you're going to use them for is their money, they're not going to be interested. VCs are unique because they want to provide strategy to your business. They want to take their expertise and help use like rocket fuel to grow your business even faster. But if you have a ton of investors and not a lot of equity to give, they're going to lose interest. So make sure you are cautious and careful of the investors you choose, because you'd rather have a smaller group of really dedicated investors than try to dilute yourself so much and get a little bit of money from a lot of investors, because once you do that, you're going to turn off a lot of future VCs and angels. This is an absolute deal killer. So there you have it. There's my best advice on the red flags to avoid if you want to get money from venture capitalists and angel investors. If you got value from this training, smash the like button and subscribe, and keep your eye out for our next training where we talk about more cool ways to get the money you need to start and grow your business.